Welcome to SG Investment. Our channel is dedicated to helping you make informed decisions about your money and to guiding you on your journey towards financial success. Subscribe now and join our community of like-minded individuals on the path to financial freedom. Definition of stocks for beginners. A stock represents a share in the ownership of a company and constitutes a claim on part of the company's assets and earnings. There are two main types of stock, common and preferred. Common stock is, common. Holders of common stock exercise control by electing a board of directors and voting on corporate policy. Common shareholders are entitled to vote at shareholder meetings and are eligible to receive dividends, but these dividends are not guaranteed. Preferred stock represents some level of ownership in a company but usually doesn't come with the same voting rights as common stock. Preferred shareholders are generally entitled to receive dividends before common shareholders, and the dividends are usually at a fixed rate. When you own a share of stock, you are entitled to a small portion of the assets and earnings of that company. As an owner, you can also sell your stock to someone else. The price of a share of stock is determined by the supply and demand of the stock in the market. If more people want to buy a stock than sell it, the price will go up. If more people want to sell a stock than buy it, the price will go down. Stock trading can be a risky business, as the value of a stock can fluctuate greatly over time. However, many people choose to invest in stocks as a way to save for the long term, such as for retirement. Why should stocks, not other investment instruments? There are several reasons why some people may choose to invest in stocks over other types of investment instruments. 1. Potential for high returns. While there is always the risk of losing money, stocks have the potential to generate higher returns than other types of investments. 2. Diversification. Stocks can be a way to diversify your investment portfolio, as they are not correlated with other asset classes such as bonds or real estate. This means that if one asset class performs poorly, it may be offset by the performance of another asset class. 3. Liquidity. Stocks are generally highly liquid, meaning it is easy to buy and sell them quickly. This is useful if you need to access your money in a pinch. 4. Professional management. Many people invest in stocks through mutual funds or exchange-traded funds, ETFs, which are managed by professional fund managers. This can be a good option for those who don't have the time or expertise to manage their own investments. However, it's important to keep in mind that stocks come with inherent risks. The value of stocks can fluctuate greatly, and there is always the possibility of losing money. It's important to do thorough research and consider your financial goals and risk tolerance before investing in stocks. How to invest in stocks for beginners. Investing in stocks can be a good way to build wealth over the long term, but it's important to understand the risks and do your research before getting started. Here are some steps to consider if you're thinking about investing in stocks as a beginner. 1. Start by setting financial goals. Before you start investing in stocks, it's important to have a clear idea of what you want to achieve. Do you want to save for retirement, build an emergency fund, or generate income to cover your expenses? Your financial goals will help you determine how much risk you're comfortable taking and how much money you should allocate to stocks. 2. Learn about the different types of stocks. There are two main types of stocks, common stocks and preferred stocks. Common stocks represent ownership in a company and give you the right to vote at shareholder meetings. Preferred stocks do not have voting rights, but they may pay higher dividends and have a higher claim on the company's assets in the event of bankruptcy. 3. Open a brokerage account. In order to buy and sell stocks, you'll need to open a brokerage account. There are many online brokerage firms to choose from, and each has its own fees and services. Be sure to shop around and compare fees before deciding on a brokerage firm. 4. Do your research. It's important to thoroughly research any companies you're considering investing in. Look at their financial statements, read news articles and analyst reports, and understand the risks and potential rewards of investing in their stock. 5. Diversify your portfolio. It's generally a good idea to spread your investment dollars among a variety of stocks in different industries and sectors. This is known as diversification, and it can help reduce the overall risk of your portfolio. 6. Start small and be patient. It's generally a good idea to start small when you're first getting started with stock investing. This can help you get a feel for the market and build your confidence as an investor. And remember, investing in stocks is a long-term strategy. Don't get caught up in short-term market fluctuations, focus on your long-term financial goals. Conclusion. In conclusion, stocks are a type of investment that represents ownership in a company and allows you to share in the company's assets and earnings. There are two main types of stocks, common and preferred. Investing in stocks can offer the potential for high returns and the ability to diversify your investment portfolio, but it also carries inherent risks. If you're a beginner looking to invest in stocks, it's important to set financial goals, learn about the different types of stocks, open a brokerage account, do your research, and start small. It's also a good idea to seek the advice of a financial professional and to diversify your portfolio to manage risk. Thanks for watching. Don't forget to like, comment, and share.